According to the 2018 Global Economic Crime and Fraud Survey by Price Waterhouse Coopers, PwC, Kenya is ranking highest in East Africa in economic crime, having increased 14% to 75%, up from 61% in 2016. Of these crimes, those committed by consumers are at 37%. This puts consumer fraud as the second most prevalent economic crime in Kenya. While terming this a societal problem, PwC says more and more customers are becoming suspects in the crime. Fraud by internal actors still remains the biggest form of economic crime in Kenya at 62%, although the figure has dropped 8% from the year 2016.
Economic crime is on the increase in Kenya, in East Africa, and also at global level. That is what the respondents have told us. In Kenya in particular, it's moved to 75%, up from 61% 2 years ago.
Middle-level managers are not off the hook, and PwC is urging financial institutions to report cases of fraud among their staff so as to find workable solutions towards curbing the vice.
Not reporting economic crime is not necessarily good news for organizations. In fact, we are saying it's very dangerous for an organization not to know whether they've suffered fraud at all. And what we have seen from the survey is that a lot more organizations are investing in terms of proactive measures, and it is possibly a big contributor to the knowledge that we are seeing with our clients.
In the survey, 3/4 of Kenyan respondents reported having experienced at least one form of economic crime in the past 2 years, a figure that is higher than the global average of 49% and the African average of 62%.
We have also seen an increase in the level of contribution of the reported crime by external players, and external actors include customers, they include agents, intermediaries, and other service providers, including shared service providers. And actually, customer contributes 58% of the fraud that has been attributed to external actors.
While corruption and bribery in Kenya has dropped, experts are urging for capacity building of law enforcement agencies to be able to deal with the fast-evolving nature of economic crime facilitated by technological advancement.
The ability of cryptocurrencies to also be used to facilitate economic crime like money laundering. The regulator is not going to endorse use of those instruments for the purpose of conducting business.
The Companies and Cybercrime Bill will help in terms of deterrence of cybercrime, which is one of the most disruptive today, and also where our respondents believe will be most disruptive in the next 24 months.
However, on the brighter side, PwC says most Kenyan companies have undertaken periodic internal reviews to ensure that compliance and business ethics programs are effective in curbing the fraud. Judith Akolo, Channel 1 Business.